There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Ovoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Steve Vetterl on the microphone Saturday morning. What is the date today? It escapes me. So as we look, today is the 14th of May. Isn't it crazy that the damn near half the year is already gone? It's ludicrous how fast time flies. So always take the time to enjoy it. One of the very little talked about things in trading land that you'll often find from some of the best traders globally is that they always take time to decompress. Some of the best traders, now granted, you know, if you're in a better position, you certainly have more time to take off, but I always am amazed that the best traders will, even though they're hungry for the game, they recognize the ridiculous amount of importance that is involved with time off, right? So whether it's something as simple as jumping in your pool or somebody's pool, or I don't know, you can use your bathtub as a pool, right? Just make up a couple of martinis. But the time off from a psychological standpoint is pretty powerful. I mean, they say time heals, right? It just depends on the event. The more catastrophic the event, in many cases, the longer the time it could take to heal. So if you recognize that time off, and this seems like, hey, why is a guy that's like trying to be a market strategist talking about taking time off? Well, I can almost tell you that some of the biggest blow-ups came from people that were overworked, under-rested, I guess I should say before that. But it wasn't, in most cases, it just wasn't a lack of preparation. It was just they didn't take time to take care of themselves, right? Drinking too much, not getting enough sleep, stress. I mean, all these things factor into, and trust me, yours truly can certainly be pointing fingers at myself on this. So, I made a pact as soon as we moved to Florida, bought a mountain bike, joined a gym, actually put on my schedule a time to work out so that I could get my, at the time, fat self into the gym and work out. Lost about 15 pounds. Mentally, it's just brings a heck of a lot more clarity to the situation. So I won't be on my soapbox too long on that, but let's say our first theme of the weekend in terms of our market strategy call is understanding the value of rest. So that being said, let's take a look here. I've got a bazillion windows open, but the only ones that matter are the ones that are related to the market. So forexfactory.com, always move forward to the next day. So the 15th through the 21st is what we're focusing on here. You can click on this little green button to get rid of the all colors but red, right? I typically keep the no event ones because it shows holidays and so forth, but just click apply filter when you're done. It will show up with just next week. So as is, unless you've been living under a rock or you're on your own island floating around with millions of dollars, you have begun to truly feel the squeeze of inflation. I don't care if it's gas pump, food prices, supply chain disruptions, Johnny's lawn mowing service charging $45 a cut, right? It's affected all of the people in a lot of developed countries in the squeeze. So the question always is, and the talking heads on television and radio spend an inordinate amount of time trying to dissect when it's going to be fixed. Nobody knows the answer to that. Just understand one of the beauties in its purest form of capitalism. I don't care what form of capitalism you subscribe to. If you don't subscribe to capitalism, I highly suggest reading a few books on it. You will start to subscribe to it. But in its perfect, beautiful nature, supply and demand will equalize. Question is how long? I don't know. I would say that probably, and I could be totally wrong on this, and this is an opinion that has probably been formed off of a lot of research and other people's opinions, right? So I can't really take credit for any of that. Probably within somewhere around a year. Could be some more pain. I'm not sure the midterm elections are going to do a lot other than disrupting DC, which more likely is going to happen. And that could certainly bring about some change. But I think really it just boils down to, supply catching up with demand. It's really that simple. Federal Reserve will do all they can to stave off this, but if they, with the 75 basis points we've already seen, and heck, at our firm, some of the fixed rates we offer clients that have no risk or any aversion to any risks, there are a huge chunk of people out there that don't care if they get 2 or 3% of their money and they're barely beating inflation. They just don't want to lose any, right? I'm sure if you guys have heard this in the past, but there have been many Nobel Prizes awarded and laureates handed out for financial theory. One of the surprising things always to me is that people hate losses 2.5 times more than they like gains. So if you appeal to those sensibilities of those that have no risk aversion or have serious risk aversion, they don't want any risk essentially. You can see that fixed rates in a lot of the areas, whether it be fixed annuities, CDs, bonds, a lot of bonds have been increasing in terms of yield offered. But what a lot of the marketplace and many retail investors are not paying attention to globally is that the prices of these bonds are actually going down inside their bond fund portfolios. And in some cases, precipitously for the higher end of the risk curve, meaning the portfolios for a lot of the junk bonds, and this is typically stuff that has unrated paper in it, has been going down a lot. This is the type of climate, if we continue to see declines, where there will be blowups in REITs, there will be blowups in anything in a real estate portfolio that is leveraged. So if you've watched, as unfortunately I am forced to every day, and an inordinate amount of financial TV because the screens are on all over my office, you'll see that the real estate and REIT-based commercials have dropped off a bunch on TV. Why? Because a lot of these are what's called Reg D investments, meaning that there is a prospectus, but you can only invest in these things if you're an accredited investor, at least in the US, which you guys can Google that. There's a fairly deep definition of what an accredited investor is. That isn't necessarily a person that's just rich. It has to meet a certain criteria. You invest in what's called Reg D or unregistered securities. So many of these unregistered securities are things like venture capital funds, hedge funds, private equity funds, right? They all kind of do the same thing these days. But in REIT land, which just stands for Real Estate Investment Trust, you can have a bunch of guys get together in whatever state and whatever type of portfolio of real estate and form a REIT, right? It's got to put some docs together and your REIT's basically live. Find a company to service your shareholders and you're in business as a REIT. What we cannot see in many cases inside these REITs is what the portfolio looks like. How much leverage are they using? right? Now I'm going to put a name out there because I just haven't really liked their practices. And I want to talk about this because we had a client we came across that's a new client to the firm that has a substantial amount of money in a company called Blue Rock, who only allows quarterly redemptions. Not necessarily a bad thing, right? But in trying, the client's got almost $1 million with these guys, and they just don't provide liquidity. They have all kinds of reasons to not provide liquidity. That's always a big issue with me. Hell, I mean, some of these strip malls this client owns could sell much faster than some of these damn REITs they have. So the onus was really on me as the advisor to do some deeper research with this client and look into what these guys own, only come to find the portfolio has almost a 3x leverage on it, which is bad situation in rising interest rate environments, right? Now you can hedge that, you can reduce but if you're using 3 condo complexes as collateral to build 2 others and they all go down in flames, the shareholders are going to blow up. And this happened a bunch in 2009. So the headwinds, which could be stronger, pose significant risk to this situation. And as an investor, and I hope all of you out there in Avoria land become super wealthy to the point where this conversation is really relevant. But make sure that you pay attention to when you're investing in something. I don't care if it's Frankie's restaurant chain, Johnny the Boxer, or whatever. These are all Reg D unregistered investments, right? If you're flipping houses with Frank and Joey, right, it's all the same thing. I'm beginning to sound like I'm from Jersey, right? But the reference to just being a private investment is what's important to understanding the difference between a publicly traded or a CUSIP listed security like you would see on a public exchange, right? S&P 500, DAX, the CAC index, the anything that trades on developed markets in Japan. I mean, they're all listed securities. There are, in many cases, with the bigger indexes, significant capital requirements and annual and quarterly reporting that are required. You can find this all in the EDGAR database at the SEC.gov in this country, in terms of the structure of them, right? Shareholders own them, they're publicly traded. Doesn't necessarily mean they're safer investments, but from the standpoint of liquidity, makes all the difference. So here's my, what was that? A 10-minute diatribe about private investments and how to be careful of that. Let's see. What did I miss here? All right, so this will be interesting. There's a significant amount of damage that took place, obviously, over the last couple of weeks. We'll go into that in a lot of markets, thus spiking the dollar and pretty much dropping every other currency out there. In some cases, some ridiculously low levels we haven't seen in years. In so one case, a couple of decades. But Chairman Powell is going to have to tread very lightly in some of his comments this week because he knows the markets are on an edge. Yes, we saw a rally this week only because we were so ridiculously oversold in equities, especially in the U.S. and tech, that a snapback is due because of all that mean reversion stuff that I've talked about ad nauseum in previous meetings. So going into this particular week, Monday, May 16th, we have, obviously, everybody's got hearings always, but what comes out of it and how the market reacts to it is what we want to base our trading on, right? So just know that on Tuesday, there's no way I would be in any trades anywhere around this or after it, okay? This is one of those things where I still think we have some sort of black swan event that's due. And, I don't know. I mean, I think that term used to carry serious weight. There's another term for it. It's also called a Hindenburg omen. So if you ever Google Hindenburg omen, you can see what that is. But there's just a bunch of things that have taken place that have really pushed down asset prices. And those will almost always trickle out into the other areas. So those of you that are dismayed or flipped out about things like the ridiculous rise in home prices. We're already seeing it start to cool off. Those assets typically will follow the broad markets in declines, especially if it becomes precipitous. So just keep that in mind from a risk standpoint. I'm not saying don't buy a house now, buy a house now, whatever. I'm just saying prices more than likely will be lower. Yes, mortgage rates will be higher. So even though you're paying more in interest, if mortgage rates drop down, you can always refi. Yes, there are costs involved. So always make sure you do the math and see whether you're going to be in the property long enough for it to pay off in any kind of refi. Unless you find a mortgage company, always dig through that fine print that will do it without closing costs. There are a few nationwide out there. So although even though they say no closing costs, they always seem to hit you with something. Anyway, what else? So we got unemployment stuff moving in Wednesday. Really not a lot coming anything midweek past Wednesday. Parliamentary elections in Australia. I don't pay enough attention to this, but this is one of those things. If there's a big old change in Parliament, maybe one side takes over from another. I pay enough attention to know what's going on in that. And people are always like, "Well, that's a precursor for what could happen in the U.S. in the midterm elections, right?" And people are pissed and disrupted and generally agitated globally for a whole host of reasons. And I think it starts at the gas pump and the food prices. So with disruption among the human race, at least in developed markets, almost always comes change in ruling party, right? This has happened for thousands of years. And what's most important is not the event itself, but what the pin action is off of that change. What happens to markets? What's going to happen to monetary policy? What happens to money supply, right? I seem to, and it's okay. And I'll tell you, I really welcome critical assessment of how I perform. I welcome it from my partners at First Down. I welcome it from clients, our outside advisors that partner with our firm. I welcome it from Avorians. And I got hit on Twitter the other day pretty hard by a guy who says, you spend a lot of time talking about macro and not enough time hanging out in micro land talking about stock trades, right? And most of these people they're just hecklers. You can tell because they only got like a couple of followers. And by the way, hats off to Elon for really creating some serious disruption, not only in Twitter, but on the board, sort of shaking the tree really hard, if you will, because it's been determined, if most people didn't know this, and most of the followers of a lot of these people, they're all bots, right? It's poof, it's fairy dust. So only pay attention to, like I said, especially on Twitter, the people that I follow, in many cases, far wealthier and far smarter than I. And that's the class I choose to run in as sort of the little kid on the block. But the important thing to understand as far as any of the changes that would happen is that hopefully change is for the better, right? As the rest of the globe understands that capitalism should fix most of these problems. It doesn't seem like, from at least some of the criticism I've gotten, which is fine. I'm a big boy, I can handle it. The criticism came from somebody that had substantial basis. Then I really would stand up and take them, man, hey, what are you doing wrong, dude? This guy is like really on your ass for these comments. And, you may be completely off kilter on this. So you should take a closer look at this. Happy to do that. But as I always welcome that, you can certainly send me an email. My email address is steve@firstdownfinancialinc.com or svetterl@avoriaprime.com. Either way, feel free to send me any kind of feedback on anything. One thing I do try and stay away from, because it does everybody no good, is calling out trades. The people that call out trades in any form, I don't care if it's anything that's in the fin media Most of those people are just looking for followers so they could suck them into whatever conundrum they've created and hit you with a subscription fee. I don't do any of that, right? So understand that I spend more time talking poorly about the financial media and many of the so-called gurus out there because the vast majority of them, if you really tore apart their life and take a hard look at them, many of them have no money. You can't track them down anywhere on social media. They don't show up in, they're ghosts, right? And trust me, I know this for a fact because we have a very difficult system to get access to at First Down called IDI Core, and it is a bananas skip tracer out there. I can see almost anything about any American resident. It's all legal, by the way, with the exception of medical information, credit reports, and financial information. And you can put a very solid assessment on somebody by just running a report on. These are the same types of deep database reports and FBI background searches that big corporations use to run executive background checks or Department of Defense or any kind of level of security access, right? This is a very difficult database to gain access to, but the only way we were able to gain access to it is because the extensive background checks by us as partners, our contribution to the community, the fact we run an insurance brokerage firm, and a whole host of other awards has gained us the ability to see this. I actually looked up, just for shits and giggles, a whole bunch of so-called gurus for particular subscribers that have hit me up for somebody. Vast majority of these people, it's all the same MO. They've got a rap sheet for fraud. Many cases, they have foreclosures and bankruptcies on their reports. They have child support back payments. They have, so in the risk takeaway on this discussion, which is maybe getting a bit off track, but I can't stand people that are putting up that snake oil salesman front. It drives me nuts. Do a deep enough search on the person or pay for a search. You can do this kind of search I'm talking about on almost anybody if you pay like $20. And there's all kinds of searches out there that can do that. Pay the money, get the background on whatever you're about to invest in big, right? If you're going to go in with Johnny and Frankie and their strip balls, you should probably do background checks on these guys before you drop $500,000 into their real estate investment trust, right? So, since Voria is sort of like a whole wealth management platform, in addition to trading systems, we have put ourselves out there as we can sort of build the whole foundation for you. I think that I could talk for hours on how to just do simple things like run one's life, but it absolutely starts from core one, and that is understanding the risk versus reward in any type of investment. So let's get into the boring stuff, the charts. Just kidding. So I'll take a look at FinViz. All right, what do we got here? Looking at 5-minute charts, we don't want that. Let's take a look at the dailies. Okay, so we had a pretty decent face ripper on what has been a long decline since darn near the beginning of April for global equity markets, right across the board. Surprisingly enough, as much as the yen has been getting clobbered, notice the market, you would think that'd be the case, right? Their equity market is not at a new low. That's very surprising in the whole scheme of things, because many markets in the US have done very poor, but their counterparts have actually done better. Haven't done great, but they've done better. And this shouldn't be a surprise. Don't pay as much attention. Keep in mind, crude and Brent in some form make their way into becoming gasoline, right? In many cases, heating oil and a whole bunch of other stuff, right? But it starts with the core, which looks like sloppy black sand when it comes out of the ground, comes into a refinery and comes out as gasoline. But there's been some disruptions in this, and now look how high gas prices are. I mean, we're back up to where we were a year ago. Keep in mind, we're on daily charts, but it's the week charts that tell more of a story. So markets are all the way back to parts of late 2020. We've evaporated all of the returns in 2021, right? This is a Fed-induced or a global central bank-induced free money rally in asset prices across almost the entire board, just completely reversed. Why? Because now you have a policy change by which will more than likely be all central banks, maybe with the exception of Japan. They already have their own policies that aren't working, but at least their stock market's not crashing. So what do we take from all this and how do we make money, Steve? I'm just saying understand the risks going on and where the trend is if you're trading anything related to equities, options, MT4 based currency pairs on indexes and the like. Not going to get too much into all this. Rally in bonds, just like a rally in stocks, it's more of just a dead cat bounce probably of which will almost continue. Dollar hit 104.50-ish. Everything else went down. And in some cases precipitously. So actually, where's the, oh, here it is. Let's take a look at the yen. Let's try this again. This tells a good story, and I always like looking at it in FinViz versus Trading View because it just shows a much broader picture of what's going on. You can see where the levels are that have to hold, which didn't hold. And that's that 80 area for trading the yen. What else do we see here? Bear with me 1 second here, guys. I got to answer this text. Trying to buy a car from these knuckleheads and they just won't get me what I want. All right. The ultimate frustration is certainly playing itself out in my ability to not want to fly off the handle on some of these guys that unfortunately I've been forced to deal with in the purchase of a particular vehicle I'm looking for without any details or calling out any names, of which I don't consider any of them to be innocent. They're all a bunch of shysters. I just choose not to deal with it. So, let's take a look at, jump back. That is just, you take a picture of this like hanging on the wall in our office, blow it up to poster size because this is just a beautiful example of the risk off, risk on. All right. So here's the dollar, broad perspective. These is a weekly chart. I'm actually going to go to a monthly It's a little bit easier to see here. Let's see if we can expand the screen a bit. There we go. This tells a huge story here. Sometimes, which is rare in one's analysis of charts and candle patterns and all that fun stuff related to technical, you got to look way back. So we are at a, I'm going to say it, multi-generational high. Write that down. Steve said multi-generational. You know, I always hated when people on TV would say that. But we are in a multi-generational high in equities. And let me just see how much battery I got left in here. So I'm pretty much mostly finished. So looks like I'm running out of battery power. Of course, I don't have my charger like a knucklehead. Risk manager, right? Did think about the power issues. Let's see if I can dig up a junky power. The problem with a lot of these multi-generational highs is that I don't know whether or not they're going to be breached or not. Why? I mean, you would think that, well, from just a standpoint of price action, the resistance here would be extreme, right? The problem is these numbers were so long ago. This is over 20 years ago that we've been here. You can always come out and say things like, maybe it's actually different this time, right? Whereas my old boss, Ken Fisher, would say it's never different. It just feels different. So, but maybe we'll be different this time. So this poses a problem for all kinds of companies that do business internationally, right? So if you're sending products into the U.S., you're converting into dollars, you're getting hammered, right? And if you're somebody that sells internationally only as a U.S. corporation and takes money in from euros and converts it to dollars, you're totally digging it, right? So, but I think at some point the boat is going to weigh too heavily on one side, and I'm going to drop into the dollar on this to get a better explanation. The boat gets so weighed so heavily to one side. Here's all time. Actually, yeah. Let's see if we can. A little better. So here's 1986. I mean, this is crazy. Obviously there was such a ton of factors that led to this. It's not even worth discussing because it was, from a capitalism standpoint, we were in such a much better place than we were here. Even the Federal Reserve didn't do things now that they did back then, even though their mandate has always stayed the same. We completely revamped the way we run a whole bunch of things. So that led to a more stable dollar, which is partially the it was not said of trying to keep a more stable currency. So it's been pretty stable, right? Versus a previous period of time where it wasn't. In any case, we have to look back further to see where the next area would have stopped would. I would have thought that we would, and granted, this is a 1 month chart. So each of these candles represent 30 to 31 days, I guess in some cases 28 days, right? So I should say 28 to 31 days. So I'm seeing huge resistance right here. So right in this 104, let's just say mid 104 area. More likely we'll pause. If in fact that's true, then we're going to see some what's called bats. That means most of these currencies that are paired with the dollar, if I'm right, will trade both ways in a sideways trade, what I like to call a basing pattern, or a trading sideways pattern until they've built up enough of whatever to break out higher, right? But I think that we probably should see higher. I'm not really sure what would happen if we actually saw the 120 area, but just note that we've jumped essentially $10 on the DXY in 3 months, right? So if you extrapolate that out, that means we could see 120 by year end. Am I wrong? If we continue on the current path, things just don't go straight up like that, even though they did go straight down. We still had periods where you had a huge movement and then a sideways trade as the market, in any market, would digest. Will there be somebody coming in to support that? Wasn't the case here. It was just a matter of time before it continued down until there was what's called a dead cat bounce. Here's that slingshot I talk about, right? It's pulling back, boom, it's going down again, ultimately making a major low in this area, which I know many have called for at this point, but I think given the reversal patterns of the past, the Federal Reserve was taking assets off of the marketplace and sticking cash on it, right? If you didn't hear me a couple times the last few Saturdays, I've talked about a circle of children represents the marketplace. Each of them have a whole pile of apples in their lap, and they either hold all the apples or they, sell a few or put them all out. Right now, what's going on is all the children in almost all of the circle have every apple out in the marketplace for sale. So they're putting tons of supply on the marketplace, and it is creating an issue. You can look at those children as an individual central bank or a regional board of governors, or however you want to look at it. But the key is that it is affecting asset prices. And for now, equities are headed down, bonds are headed down, commodities in terms of inflation in most cases are heading up, with the exception of the metals, which is the perplexing part of this analysis. If you look at the metal space, this is it's almost counterintuitive. It's almost like confusing. We're looking at a long-term chart here, right? So many expected this to be up here instead of just an absolute floor. But I said, remember, there was plenty of tells every time we rallied a big time. It was almost like it didn't show up as an island reversal pattern, but it certainly felt like it, because anytime this metal rallied, there were sellers in there to just start dumping. And I guess my suspicion was either a bunch of huge funds. It could be any type of fund. It could be a sovereign wealth fund dumping, but they were just unloading, right? And regardless of what you may think this price should be, you trade what you see, not what you think it's going to be, right? So the market gives you what most cases don't want to see, but you've got to trade what you have in front of you. That's a core theme to risk management. Don't trade in if any theory you think you have, trade off of the current. Right now, that is down in metals. Generally, I consider gold to be most of the metals. The other ones don't carry, from a trading perspective, nearly as much. I really talk about them. All right, so I think that's all the comments I want to make on the factory. It's enough for the futures. Let's go take just a quick look at some things that I told you guys to stay away from, and that would be anything long the euro. Although I got to tell you, and let's get out of this monthly. It seems to me, from just looking at it, I could always be wrong, that we probably got some digesting to do of sideways. So essentially, can you go in and trade both sides, or if your algo is a martingale, it's taking trades on both sides or whatever. I think the pain may be at least partially paused with the rally on Thursday and Friday. So even though the pin action may not come off of equities into currency land, we may continue on the path of decline or the path of increase in terms of US dollar. I think we're due for a hold. It's just been too much too far. If you take a look at weekly charts for a lot of stuff, and we're riding the bottoms of the Bollinger Bands, which is stretched way out. And just remember, if I've never told you, these bands are very effective in keeping price sort of contained or telling you when it's gotten to an extreme. These bands have expanded out, right? So the top band, the top band here, this teal band, had a very narrow range here, right? So you'd think, okay, well, we're confident as things got more volatile, these bands will expand out. The much more stretch comes that when you're actually, not only are the bands expanding way out, so the rubber bands will really get some of that band. That cannot continue. At some point, this is going to snap back. How much and how far and how fast? My argument would be somewhere in this 0.07 area. That would be my argument. That would be your slingshot. It would be your dead cat bounce. So just keep that in mind if you're trading this manually on a longer term chart, right? Most everything I'm talking about is strictly just long-term charts. I rarely make reference to anything 1 hour, half hour, 240, 15-minute, 5, any of that stuff, because one, I'm not here to call short-term levels. I'm here to talk about the implementations of long-term levels. If you understand those implications, it is much easier to dial it back into a shorter term, and then use some of the great tools we have and trading calls and so forth, like an arrow or some of our other great systems to let it trade. But just know of those points in terms of broad. Let's see. Interesting note how we broke above. Let's take a look. So this could be a pretty good example. Let me expand this out. And for the question I just got, none of these indicators are any sort of like hidden or specialty thing. They can be found all over TradingView and some of the forums. Some of the guys that I follow, you can follow. Dasan's built some of these indicators, which have been quite effective for me. I use most of these in just understanding markets from a broad trading perspective, whether it's the stretched reach of any candle movement via Bollinger or Keltner channel, the moving averages that you see here, as well as just the price action and the support resistance points. You can highlight an indicator here and then just right click on it. If you want to make any of the change to the settings or anything related to the indicator, you can open it up by just double clicking on one of the lines, because this is called the squeeze zone. Those are my settings. All right. Take a look at GBP CAD. Yep. riding the bottom of that Bollinger, man. Just amazing the weakness of the pound. Just jump back to U.S. pound. Dollar cable. Let's take a look. I mean, daily's going to tell the same story. Weekly's cutting out less noise. Coming back down to the lows of where we were pandemic. Pretty solid support here with lifting volume the last time it touched this area, which was April of 20, coming up on 2 years ago when we got to this level. 1.208-ish, 80-ish. Probably will go test right to that level. If we continue this overextended into this level, that's one of those real rare outside extreme moves that, stepping in front of the fray to avoid this, I can actually take a crack at. It's actually going to be a pretty decent trade right here. Don't know how long I'd hold it, but we'd be looking for a big fat slingshot, probably back to somewhere in that 25 area on this trade. So this would be like a multi-day hold for me. Typically, this type of trade has to set up in the following. We're looking at weekly charts, right? So ideally, what I'd like to say is switch back to the daily and see it just try and slam into this 2088 area, which is a pretty decent move into this area for a counter trend trade. So that would put us wanting to hit, what did I say, 2088? Right? Is that about right there? There you go. So we'd be getting closer to the Bollinger and a very long-term area that likely is some sort of support for some sort of institution, I would imagine, from a pound standpoint, that would be stepping in to defend it. Just a hunch. As one follower asked me, Steve, you could be wrong. Yep, because it's true. I could be wrong, right? Don't blindly go into the darkness with anybody, regardless of how great their analysis is, because like a broken clock that tells the right time twice a day, but is wrong the rest of the period of time, I could be wrong. And with that, let's look at an area. What's wrong with my computer? Let's look at a situation of, wait for it, I told you so. So for anybody that's been listening to me, I had hope for crypto. This is the type of move that exhausts, by the way, look at the volume. Okay, so it's the daily chart we're looking at here. Expanded it out. Look at the volume. This volume could be a capitulation move. What's that mean? So let me see if I can expand this out. Let's just get like super detailed here. A capitulation move comes where, in this case, if I'm one of those starry-eyed crazies, and by the way, if you notice, most of those Twitter accounts have completely disappeared. So it's almost like the bots that those things built to pump crypto all blew up, and they just disappeared. That was kind of funny. By the way, there's capitalism completely leveling the playing field for you right there. But it's a lot of volume. So, I mean, this is a ton of volume in relation to the past, and I'll drop back so we can compare that to the past. But these capitulation events are usually a very short-term indication of it's about to get absolutely wicked ugly in whatever the asset is you're trading, right? Because a whole bunch of big dogs dumped, or could be 100% negatively correlated to what's going on. So a lot of times these sell-offs will bring tremendous buyers into the marketplace because a capitulation event took place. So what's a capitulation event? I started to drag it out. You can Google it. But in my opinion, it's everybody that's going to sell sold. And now there's no more sellers. I don't know if that's the case because crypto brings a whole host of other risks into this discussion. But the point is that we had a huge vol day. When was the last time we had a huge vol day, and what happened after that, right? That's the question you always want to ask from that standpoint. Last time we had a big vol day. Remember, I kept saying as soon as we get out into this, you guys are just going to have just a puke day, capitulation day. That's usually short term, a time to step in and buy. But in this particular case, the prevailing winds are too strong. I think this thing's going much lower. You can see it in the tea leaves here. So let's look back. Look how far we got to go back to see an event of this magnitude. This is May 21st. And it was a capitulation day that, yes, we tested the low of that, but it was support. So let the further lesson here be, will this be the ultimate low? Somebody got a decent fill down here. Whether it pays off for them, I don't know. I would imagine ultimately the test of this will be whatever ensuing patterns play out as we build candles along this base, right? So I'm just drawing what could be a range that we stay in across this. So we're trading within the range. Ideally, from a going long standpoint, these are the types of patterns you want to see. And then things lighten up real light, right? And then you have that handle breakout, little cup handle. We form a cup with a little handle, and then we break from that. It's the best and the highest win pattern of anything out there, bar none, historically. Win rates, bananas high. If the pattern is correctly identified and it is played out well. And if, it's like 14 ifs. If you want to read more about this guy, you can get a book that is one of the best on this planet for this. It's called How to Make Money in Stocks. It's written by William O'Neill. He's the founder of Investors Business Daily. They're a large institution in Los Angeles. They have one of the best databases outside of Morningstar and Bloomberg, period. In what makes money in stocks. Most of the gurus out there that pitch their own systems is a wolf in sheep's clothing to a cup with handle patterns of it. And certainly you could argue, Steve, you're wrong. I got this pattern's been better. And I'm just telling you, I take my rock chiseled 10 commandments, if you will, from ridiculously large data sets that cannot be disputed, right? In the end, the one cannot argue with if these 14 things line up and a cup of handle shows up, you have breakout patterns and increases about 85% of the time as a win. It's almost impossible to argue with that. So the one tip I can give you is to study that pattern, know it with standing on your head. We used to joke, you would know it cold standing on your head after a case of beer tripping on acid. Right? So that's just knowing something just cold. And then you'll be able to recognize that pattern. That pattern can show up anywhere. It can show up in a 5-minute chart in currencies. It can show up on, the ES futures markets for the S&P. It can show up on gold, show up on the price of local used cars. I mean, any of that stuff that you have an actual liquid market that is unfraught with data errors and risk, but clean data that can be aggregated. So I see lower. But this was an event that we could be a bottom for some time. And with that, I wish everybody a very, very profitable and extremely high net worth future. My name is Steve Vettel. Today's the 14th of May. Have a great weekend.
There is a substantial risk of loss associated with trading Forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Ovoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.